What's up, everyone? Welcome to Drive-Thru Trading. Our boy Steven should be making his way in momentarily. There he is. And so this series thing is taken a little bit of a shift from the original intention, although like our original intention was pretty loose, I would say. We just kind of knew that we like talking markets together and then figured it would kind of go where it's going to go. But I actually really like the idea of continuing to mold this idea of analyzing the market from our perspectives, because again, like as we talked about before, there isn't necessarily a super deep repository of options trading experience on your side, but you've spent a lot of time looking at markets, monitoring things, understanding sentiment, which is still super useful. And marrying that with a little bit more of how I perceive and approach markets, which is actually really different in the sense that I typically don't know what the fuck's going on. I literally don't. And I actually prefer it that way, but it's also kind of fun to look at stuff. I was actually reading a bunch about, was it Okra? They had a nuclear reactor video that literally showed like their process for starting the nuclear reactor. It was fucking sick. Super cool. So Steven, do you go by Steven? Steve? What is it?
I go by Stevie to my best friends, but no, Steven. Steven's good.
I couldn't call you Stevie because that my mind goes directly to like Stevie Wonder.
Mm.
And I don't know any good nicknames though for Steve. Steve,
Ste Steven
Steven.
works. Classic.
Steven sounds too formal though. Is
Uh,
there with your name, are there people that are like literally named Steve, like actually Steve, and like that's a normal name, or is it almost always Steven and then they just go by Steve?
I don't think anybody is actually just named Steve. I think that's just like a abbreviation, like a Dave for David, but I don't know. Are people named Dave? I think some people are.
Damn, I wasn't ready for that much of an existential question to start. That you had my mind in a bit of a blender there.
I mean, you
So,
could call me by my Xbox gamer tag,
which is
Cake Gourmand.
cake,
Yeah,
CG.
CG.
I like CG. Yeah, cake Cormon is great. Okay, so we're going CG. You have to change your fucking thing here. CG is way
Hmm.
better. I'm literally going to change you in my phone right now to CG so that I can begin that mental shift. Just way better than, I mean, Steven's fine, but CG, I like, I also just really like any sort of call out to Xbox gamer tags because they're just so ridiculously fun.
Yes, I do not
I
get
think,
to use it enough these days,
what
but
is mine? How do hold on, let's see. Is there like a Xbox.com?
I think you'd have to log into your Microsoft account.
Which I'm always in that. So let's see. Ah, mine's Dead Rising. You know what that's from?
You must have made that during the like Nazi zombies Call of Duty days.
Before that, Dead Rising is like an old school, I want to say George R. Romero, like the OG of zombies. It was like a old school movie or something that he did, but it's like it's an actual zombie movie that's splendid, by the way. And yeah, that's where that comes from.
Interesting.
So let's talk first before we get into markets. And you already know we have a question of the day. Don't worry.
Mhm.
Don't worry. CG. It's here. We have it. And I know that you are eager. I can sense how eager you are for it. So I'm not gonna withhold. What's up, Lauren and ZX? They're there to help you. Lauren and ZX are there to help you. See, the problem is like Lauren, she'll support the hell out of you, but a lot of times, well, this is kind of not true because I was going to say a lot of times she's just fucking guessing. But yesterday there was a pretty good question that she just guessed at, and she completely correct, 100% correct on the guess. And it was actually like a pretty technical question. It was about stripping out event vol from a term. So what that means is if we think about an option, let's say it has 5 days to expiration. And let's say it's like a normal week. Each of those 5 days probably has about the same amount of volatility in it. Because it's just a normal day. It's, there's no like big economic events that impact it. It's just normal days. But if you have 5 days, and let's say earnings is one of those days, it creates an interesting problem because when you see the volatility for that expiration, it will be very high. So then the question is, how much volatility of this heightened volatility that we see is actually attached to earnings? And then what's the residual for the normal days that we have? First, does that make any fucking sense whatsoever?
Yeah, that makes sense to me.
Okay.
Yeah.
So what you can do is actually, Thor, stop that. You could do a little bit of math, and it's actually really easy to extract because we can see like what the normal days look like. What does the weird term look like? How many days are in the weird term? How many days are we trying to pull out? Normally one. And then we can literally break it apart. And we can say like, yeah, this is the actual event volatility that we see for this specific thing. And then this is the standard volatility. And there's actually a calculator that I built with the community to do this exact thing because it's generally a good place to be. Let me grab my screen really quick. How do I keeps reorganizing my shit? It kind of makes me mad. So I'm going to share my screen and I'm actually going to show you the question of the day yesterday. And then it's just because it happens to be up. And then we'll talk about that event fall thing. So this is the question of the day from yesterday. This is the one that Lauren knocked it out of the park and she got it right, which is the exact thing that I was explaining in terms of event volatility relative to standard volatility. So what this is saying is that there's 7-day at the money vol. So at the money is either call or put. Normally it's the first strike that's out of the money. And you always use, when you're looking at volatility, you always use the out of the money options. Are you familiar with this?
Oh, in the money versus out of the money?
Yes, but specifically that when we're looking at volatility of an option, we're using out of the money options. Are you aware of this?
No, I wasn't.
Okay. There's a very specific reason why. In the money options can become really noisy because they have a lot of intrinsic value that now is part of the system. And people might think, well, intrinsic value is just how far in the money it is, which definitely is, right? Like that's the logical component. But a lot of things in options are actually really, really nuanced. And even the attribution between intrinsic, extrinsic, and then subsequent volatility are not uniform. So what that simply means is if you're looking to figure out like what the volatility is for a strike or a delta or something like that, you want to go to the out of the money options. And it's when we're looking at things like skew, term structure, we're using out of the money options. We're not using in the money options. That doesn't mean you can never use it in the money options. You just typically don't want to. It's a really noisy metric. So this is saying that there's 7-day vol is 80%. And it says annualized IV. IV is annualized. It's inherently annualized. So it's like adding that, but you don't really need it because that's already what it is, just so you know. So when we see like 7-day volatility is 80%, that's an annualized number. That doesn't mean that we expect the thing to move 80% in the next week. This is an annualized metric. And then it says, well, it's 14-day at the money options trade is 60%. So we can see that earnings is in 6 days. That volatility is going to be in this term, but it's not going to be as dominant in this term because it's going to be in both terms, but it's not going to be as dominant in this term because this has 7 days. One of them is an earnings day. This has 14 days. One of them is an earnings day. So that volatility that you see here is being spread across 6 normal days and 1 fucked up day. This one's being spread across 13 normal days and 1 fucked up day. So then it says, assume both expirations contain the same earnings event. Non-event variance is constant, so just isolating the event itself. And rates are negligible because things like interest rates and stuff like that also are potentially impactful. So there's literally a formula. The correct answer here, by the way, is C. And it's just math. It's literally just a formula. That's something that we'll get to in the future. Doesn't make literally any difference to you right now. It doesn't matter, but it's good for you to just start become exposed to the different ways you can use derivatives. That's the cool part about them. Even if at the end of this, whatever this thing is that we're doing, but like even at the end of like you learning about options and whatnot, if you arrive in it, you're like, fuck that. Like that, there's just too much. I don't feel like doing that, which is super reasonable. You can still use all these little tools and tricks to help your stock trading. You could say, well, do I want to hedge maybe for this one event and how much am I paying for it relative? Maybe it changes what term I'm going to use. So we literally just looked at an example of that in the workshop on Monday. That was the Pro Plus workshop. And we had a member that was interested in holding shares of stock, but they were only able to put on a really small position because of the volatility. They didn't want potentially huge P&L swings. And funny enough, it's like it's the exact use case for protective puts, for long puts. We don't talk about it much because from a trader's perspective, most of the time we're trying to monetize that. But there can be a really good use case for that, even if you're not like a big options trader. So let's take one pause, and I want to understand from your lens, Steven/CG, when it comes to options, you are around them a lot, but there's obviously a reason why you haven't started using them already. What is that?
Well, I know they're just like, well, to me, they are much higher risk. So unless you have a good understanding or like are an expert, you have a good probability of wrecking a portfolio, basically.
And why do you think there's a bigger probability with options versus stock?
Because options can go to zero in like a day, a week, a month, versus stock, which, it's really never going to go to zero unless you're in something crazy, but such a lower probability of like losing all your money.
Good. And what's the other thing that's inherent about derivatives versus equity outright?
Like the time component.
Mm-mm. That is definitely part of it. Leverage. You can get leverage with equities, but the base equity position isn't levered. With options, any options position you put on is levered right from the jump. Even you could argue a cash secured put, because depending on if you're in a IRA account, a little bit less so, that cash is like really parked. But if you're in a margin account, even though it's a cash secured put, you can still do other stuff with that cash while you might be waiting for that short put to resolve. But that's the other piece to it. So we know options add a lot of complexity. So then that begs the question, why do you think people like me exist that lean into that and trade options versus other stuff?
Because I think the opportunity to beat the market returns is definitely there. You just have to you have to have your emotions like seriously in check, and you have to have a strategy and structure that's like super rigid and like formalized to kind of harness the emotions, I think. But you can make more money basically because you're using leverage like you're saying. So you have the opportunity to make more.
Wouldn't emotions apply to stock trading too?
Yes, but I think there's a spiral nature to emotions where it's like if you lose 10% in a stock over a year versus losing 10% in an option in a day or a week or 50%, or there's like a point of no return, I think, where you just spiral.
I actually love that. And I think it's a great point. And I think in general, there's a lot of nuance that comes with options, but the reason why people are drawn to them in general is they're referred to as strategic or tactical investments. You kind of, for the military mind, it's bizarre to hear strategic and tactical combined. They're actually like two different operational levels for us. There's like strategic, operational, and then tactical. It's like very defined differences. But in the trading world, they just kind of use those interchangeably. But the main reason for that is there's you can build very specific things. You could do very, very, very specific things with them. And we're going to discuss a little bit more about that as we make a little bit more progress here. But first, let's start with our question of the day. So we'll kill this one, drop our new one in, and I'll turn it over to you.
I'll read it for the chat so they can know
Yes.
the answer. All right, here we go. Everybody, let's work together here. SPX trades at 7,700. A 1 month 25 delta put has a 730. How would you say it? 7,350 or 7,350? I feel like you say it differently.
I would just say the 7350.
7,350. Okay, yeah. Okay, so
Yeah,
25 delta.
the weird thing about that is that it's kind of contextual because like 7350 could be a bunch of different numbers, but as soon as you know you're talking about SPX, you kind of know. The other thing actually that you'll learn is that a lot of us when we're quoting SPX, we won't even use the first number. We already know it's 7. So the only time that we might quote it is if it was like 6. So if it was like 6,900, that's different. But a lot of times, if I was quoting SPX here, I would just say it's at 700.
Mm-hmm. Interesting. And that's because the people following the market every day like understand where
Yeah,
it's at.
you just know, right? Like you just
Mhm.
and it's that actually stems from like just think of saying it, right? 7,700, 700, right?
Mhm.
It's literally just faster. And you can have that implicit understanding of where price is.
Interesting. All right. Let's start back from sentence number 2. A 1 month 25 delta put has a 73.50 strike and 24% IV. At the money IV is 17%. SPX falls 3% instantly with no passage of time and no change in volatility. Surface when expressed by delta. What is the most likely effect on the original 73.50 puts implied volatility?
Okay. Let's break down what you're seeing here. SPX trades at 7,700. You know exactly what that is. Spot. A 1 month 25 delta put right now is a 73.50 strike with 24% vol. Does that statement make sense to you?
Um, I want to clarify. So like the 73.50 strike, the delta, would that mean it's 0.25?
Bingo.
And then 24% vol, where does that come into play?
That tells you what the implied volatility is being priced into that option. Remember, the implied volatility part is actually probably the most important part of an option's value. Oh, I was just about to start drawing for you, but I realized we have this open, which has this. This is like my random deck that I built for this. It's so funny. I literally built it for like a couple small things, and over time, it's over 1,000 fucking slides now. It's insane. It's turned. Look at my table of contents. It's
You're a professor.
turned. Yeah, it's turned into an absolute bear. It's kind of funny, but let's take a look at this. I think here we go. So here, what I'm showing you is what we use in an option pricing model. How do we determine the value for an option? And there's a few inputs. Now, a lot of times you'll hear it referred to as like 5 inputs, which it's fine. Like it's fine enough. There's a handful of key inputs. There's spot price. What price is the underlying at? The type of an option. So is it a call? Is it a put? Is it American expiration? Is it European style? Are you familiar with American versus European?
No.
American style options, those can be exercised at any time. European style options can only be exercised at expiration. That's it. There's no early exercise in European style options. So the most common European style options that you'll see is SPX. SPX is an example of a European style option. There is no early exercise. The other interesting thing about SPX, because it's an index, it's also cash settled, which is a slight difference compared to most other options. Sometimes people will mistakenly think European style option automatically means cash settled. Not inherently so, but a lot of times it is.
Do you have to clarify that every time you buy one, or is it auto to US if you're in US or
No, you don't get to pick. It's the type of instrument. So if you trade SPX options at all, you are trading a European style option.
what's the history of that European name? Anything interesting?
It's
Because
a
why would
fantastic question. I actually have no clue why we arrived. My guess is maybe just the way that the derivatives markets were set up in US versus Europe, but it's a straight guess. I do not know. Yeah, I'm not sure. So the type of option, then we have strike price, days to expiration, the current risk-free rate, if there is a yield, and then implied volatility. So there's really like 7 primary inputs into a pricing model to figure out what an option should be priced at. The reason why I went down this little bit of a rabbit hole is because you'll notice that 6 of those 7 are all knowns. We know what all of them are. We know what price is. We know the type of option. We know the details of the option. We know all of that. The only thing that we don't know is volatility. This is the only thing that we don't know. And realistically, it's not implied volatility that goes into an options price. It's just actually, it's called a forecast volatility. It's a different thing. So what I'm emphasizing here is the reason why this matters is because it's the only part of an options price that is actually unknown. We don't actually know what the volatility is going to be. It's forward looking. So there's a difference in types of volatility. There's implied, which exactly as the name sounds, we're implying what the volatility is from market price. That's it. We're looking at the current price that's quoted in the market, and we're stripping out all the shit that we know. We know the DTE, we know the type, we know all that stuff. We can strip all of that out and arrive at the volatility that was input to get to that price. That's why it's called implied. We're literally implying it. But somebody needs to figure out what that number should be. Right? Somebody has to put it into the model at some point in order for the quote to exist for us to imply it. That's called a forecast volatility. That's mostly what market makers and entities like that are actively doing. So that's why this is actually really, really, really important. It's effectively telling you the value of the option. Like that's it.
if you got all of those, whatever it was, 6 or 7 inputs, are you at the point where you would know what the options price is going to be without knowing like the price of it?
You mean like could I calculate it?
Yeah.
Yeah, absolutely. It's not difficult. It's actually just part of that's one of the reasons why we use the Black-Scholes-Merton model. It's just a differential equation. So I don't know what I have. I feel like I gotta have something in here about option pricing models, right? Let's see.
I watched your recent conversation with I think his name is Tom Saznoff,
Yeah, Tom
maybe.
Saws.
And I think he was talking about this with like new IPOs, and it's specifically the SpaceX one of like how quickly the algorithms can like understand the volatility and create it nowadays. It was
Hmm.
interesting hearing him
Yeah,
mention that.
yeah. I think that's exactly correct. And that's why like the models, I thought for sure I had something, but apparently I don't. Maybe that's something that I need to build something in here for you. But the there's different kinds of pricing models. The one that you'll hear the most is BSM. Most people mistaken that for Black-Scholes model. It's actually Black-Scholes-Merton. There's Merton was added on later because he came up with a couple adjustments to the model that were kind of important. But it's literally just a differential equation. That's all. So that's how we can use something like Black-Scholes-Merton model to figure out if given all the other details for this option without the IV, or if you're given the IV, let's say you're given price and no IV, you can figure out the IV. If you're given IV and no price, you can figure out the price. It's just like algebra. It's just fucking slotting shit in and out. Super easy.
Now I have a question for you. Can you spot, or is this like a discretionary thing? Like if a IV is not where you think it should be, and that would be a market inefficiency, and is that something you would look to like target then, or
It's a fantastic guess. The reality is that's so rare. The market like that's kind of what high frequency trading is specifically looking for is to price those back in and take advantage of those opportunities when you see vol step out of bounds. The only time that you'll really see really weird vols is when it's fake. So that means like if there's like a really wide bid ask spread, and let's say that you see an option that has like 50% vol and then one strike above it, it's like 250%. It's like it's not 250%. It's just because it's super liquid and that's the vol that needs to be used in order to get to the bid ask spread. But that's not the actual vol that that's transacting at. That you'll see pretty regularly, but you can't like there's nothing for you to trade there.
hmm, makes sense.
Perfect. So then the next part is at the money IV is 17%. Does that make sense compared to this?
I think intuitively it would make sense for like the at the money IV to be lower than out of the money, but could you explain that?
This is just giving you the skew. This is telling you that the 25 delta option is 24%. The at the money is 17%. More often than not, this is normal. As you go further out of the money, you'll see skew go up. And it's for different reasons, but that's also part of, especially on the put side, of risk premium because the market definitely fears the downside a little bit more and blah, 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 blah. But for the context of this question, the only thing that you really need to know is the way that it's attempting to get you to think about skew and the relative volatility between these points. That's all.
Okay. And
Okay.
skew would work in both directions from like at the money, bullish, bearish. And you said it's a little bit more towards like the bearish side because people are hedging and the market trends upwards usually. So,
Yeah. So there's different ways we measure option volatility. There's what's called skew. Skew is when we look at strikes within a specific term. So in this case, if we're looking at the 1 month term and then we're comparing the deltas and the volatility within a 1 month term that's called skew. When we're looking across expirations, that's called term structure. So if I'm comparing the 1 month against the 2 month, that's term structure. And then the volatility surface is both of those combined. It's when we're looking at skew and term structure at the same time. And there's literally really cool ways you can visualize it to kind of like make it a little more intuitive or make it make sense. And what I think you should pay attention to here is the terminology so that you get more familiar with it. But so far, you now know what skew is, you know what term structure is, and you know what the surface is. Make sense?
The answer is A.
Okay, so we think the answer is A. And the answer is it's IV falls because the option has become closer to at the money and now maps to a lower implied vol delta. It's exactly correct. This is what we call, there's two different terms that we use regularly for stuff like this. There's things called sticky strike and then sticky delta. So sticky strike is when we pick a strike, and that's what we look at when we go to different expirations and stuff, when we compare those. Sticky strike. Sticky delta is the opposite. So if I'm in 1 month and I'm looking at a 25 delta put, and then I go to the 1 month, or I'm sorry, I go to the 2 month and I look at a 25 delta put, those will have different strikes, but I'm comparing the delta. So sticky strike, sticky delta. There's different pricing models and whatnot that allow you to use those in kind of different ways. Some of them useful, some of them not. But sticky strike and sticky delta are concepts that you should at least be rudimentarily familiar with because they'll come up a little bit more in the future. And going back to what we were talking about a little bit before, this is what an implied volatility surface is. So the implied volatility surface, it allows us to look at things in a few different places at once. We can see implied volatility, we can see DTE, and then we can see relative deltas. So here, what's interesting is more often than not, you would expect this to slope up as we get closer in time. And as you're further out of the money, you tend to see vol going up. And you'll notice this saddle. This saddle exists because as you start getting deeper and deeper in the money, it becomes noisy. Your implied volatility gets really noisy. So more often than not, a lot of times when we're looking at stuff like this, we'll literally limit it to like an at the money so that this you can see and measure. So you can see that the option in here, this is Apple. What this is telling you is that the at the money vol for a 4 DTE is like 31.4%. And then for the wing, it's 34.5%. It's way higher relative. So then some of the interesting places you're looking for is shit like this, these valleys. Why would vol be so low in here compared to here or here? Sometimes there's a reason. Sometimes there's not. Sometimes it's just shitty quoted options because they're a random illiquid contract. So this is in a nutshell, though, what a surface is and how you can use a surface to find just things that look weird in one spot. It's a way to look at both term structure and skew at the same time.
Well, this is a personal anecdote, but I'm really into this like thing called sacred geometry, which is like symmetrical patterns.
Oh
And I really love
God,
like,
this sounds like fucking astrology. Are you about to talk to me about astrology?
well,
Sacred geometry? What are we doing here? What
well,
are we doing here?
I was not going to get into that side of things, but just more the geometric patterns. I really like this presentation of like the information, like seeing it on a chart like this versus the numbers on a in a table. It just like it speaks more to me. It's much easier to see. So this is a cool way to represent it.
Great. I'll call it the sacred IV surface if that helps you with your fucking voodoo, whatever that shit is. That's in sacred geometry is an insane, that is crazy work. I did not realize that we're going, for everybody in the chat, just be aware. Apparently, we're going straight cult. That's what this is. We're going to be a cult soon. I think that's one step before we're a cult.
We're already a cult. Come on now.
Yeah, I think that's probably fair. That's probably pretty legit. I'll give it to you. I'll give it to you. Cool. So does this in general make sense? And I'm actually really glad that you got that right because a lot of people would guess wrong here. Like most people would guess this wrong. And they would expect some sort of monotonic relationship that doesn't necessarily align like that. So it's good.
I would not have got it right had I not asked that question that you answered, which made it very clear once I got that answer. But yeah.
Yeah, that's awesome. And the last thing to note is there's a ton of information in the volatility surface. You can detect if the market is pricing in events. You can tell if the market is pricing in floors. You can tell all sorts of things. So that'll be stuff that you'll kind of pick up on a little bit more as we just, explore options a bit more. And you'll get a sense of a lot of different ways that you can use them. Some of them, again, they're not stuff that you're necessarily going to use all the time. Others, maybe so. We'll see. We'll see how that all pans out. TBD, as it were. Okay. So you were talking to me, well, you sent before like a list of ideas that you had that you think are generally interesting. So the first thing that I want to talk about before we get into any of the general ideas that you have, if you were to think about the way that you would approach trading, what kind of time frames do you think appeal to you and for what reason?
I think starting out, probably a little bit. I don't know how like traders think about it, but I would think I would be on the more longer term scale, like, 6 months plus, maybe 3 months plus. But then as you get a better understanding, maybe you could like go closer if you get a better, I don't know, better feel of like how the tools work and all that. Because I do feel like I can like directionally see things in the market pretty decent. Um, but I think like I'd be nervous to go too short time because obviously if you're like a week or a month, like and you're not right in a couple days, I feel like you could get really messed up. But I would say like a couple month time frame at least would be like the
What
minimum.
what do you use for like a trading platform? Like where do you actually execute trades?
Robinhood.
Oh my God.
Okay, can I give context before before you answer?
Oh
So
my
I
God.
started investing in
I
2017.
can't hear anything right now.
Okay,
I'm not
before
ready.
the
I'm not
GameStop
ready.
saga.
I'm not ready. I'm
They
not
never
ready.
did anything wrong to me.
I can't.
I know they get a bad reputation, but I'm not a trader, so I'm just buying things, right? So it's like,
Okay.
I know I say that in shame, but why am I gonna switch an entire account? Just they didn't do anything to me.
They do do to you. It's their fills are god awful. There's literally research that exists about
Oh
it.
yeah,
And
if it's not like a main like a stock that's like if it's just a random company, sometimes the price they show you and what you get filled at is completely like ri that is one thing like that is ridiculous. Like how can you just show me a price and it's completely different? But I feel like that's kind of
um
rare.
so okay. Okay. It, well, you're paper trading, so it's okay. But before you trade options, if you ever decide to, gotta fix that. Got
Which platform do
you
you
got
use?
you gotta fix it. You gotta fix it. I use Schwab. So
Well,
I've traded on Thinkorswim since like it's just the first platform that I started with. I really have no allegiance to them. I just happened to pick it. It was random. Like I had a random list of stuff that I could pick, and um I picked it. I learned the platform. I like it. If I were, again, like most people, like if somebody from the chat I was talking to or whatever, I really wouldn't have an opinion. I would say kind of like do whatever you want, right? I really view myself as like provide information, let people do what they want. But when it comes to like people I consider friends and whatnot, to good or bad, way more forceful because there's normally like really specific reasons behind the various opinions that I have. So when it comes to brokers, I would push you either to something like Schwab, IBKR, like both of those are just really good places writ large. And in general, I think IBKR is probably even a little bit better. The only thing is that I actually really like the Thinkorswim platform. It's pretty powerful, has good tools. That said, they're not really updating it much. So I've looked at and I use IBKR. Their tool is called Trader Workstation, and it's pretty good. Like it's legitimately pretty good. So I would say either of those would be completely reasonable places for you to be. But I mean, joking aside, Robinhood, especially for small orders and stuff, it really doesn't fucking matter, man. But the important stuff is to be able to like see the information that you need. And that's one of the main problems with platforms like that is that they obviously lean really heavily into like making it easy, which is good. But when it comes to options, you end up neutering a little bit too much and you're not actually getting the fucking data that you need in order to make good decisions. So the reason why I say that is like I actually think it would make sense for you to even set up an account with any of them just so that you could use the fucking platforms. Because you're not going to be able to analyze stuff that well with Robinhood. I'm not saying you can't analyze it at all, but you're not going to be able to analyze stuff really that well in Robinhood.
what is one of the platforms where you've been showing like all the information so far? Is that the Thinkorswim?
Um, that so I'll show you right now. I'll show you Thinkorswim right now. Thinkorswim is where we were looking at the actual trade details. This. This is Thinkorswim. The other thing that you were looking at, this thing, this is my own tool. You can see it's locally hosted. So this is called the OTOC, the Outlier Trading Operations Center. It's literally just something I built for myself. So this is like I can execute and stuff through this if I want, but this isn't like a broker provided tool at all. This is all custom shit that I built.
What about when you show the like line of the option like probabilities or
The payoff diagram,
yeah.
sink or swim. So if we look at SPY and we look at buying a put, this is called a payoff diagram. And this is in Thinkorswim. This is a really useful tool.
Yeah,
A
like
lot
that.
of like actual brokers will give you like pretty good versions of these, real brokers. So like you'll get this at Schwab, you'll get this at IBKR. Like this is it's kind of like industry norm to be able to look at structures and whatnot. One of the things that's actually very cool though about Thinkorswim, and again, I can't speak to IBKR, I just don't know it as well, but you can actually look at your entire portfolio as well as one payoff diagram, which
Oh,
is
that's
actually, yeah, it's super useful.
do you do that?
Yeah. Oh, yeah, definitely. Because especially when your portfolio is larger, sometimes you're looking like, when the market's doing X, Y, or Z, you're not necessarily looking at it like, how do I adjust every single one of these positions? Sometimes you're just like, what kind of fucking deltas do I need to hedge or to just skew my exposure for this whole fucking bucket of shit? So definitely, it's actually quite useful.
It's a good question in the chat from Lauren because these places got to make money. So is it free trading? Is it payment for order flow? Is there a fee for the?
Well, the platform's free. The way that a broker like this makes money is you do pay for trade sends. So as you send trades, you pay. They also do have payment for order flow unless you manually route your orders, which you can. So you can route your stuff to exchanges that don't have payment for order flow if you're so inclined. So it's primarily making money via two primary methods off of you. First one is off of your transactions, just like every other broker. And then the second piece is just like standard bank functions by loaning your money out. Yep. So this is free.
I think I'd be inclined to just use this one since you're showing it to me while I'm learning, and it'd be good to keep it consistent. I'd probably just
Yeah,
join up here.
it's fine. I would say whatever. I would say just take a peek, maybe watch a YouTube video about both of them and see, which one strikes you. You're
Hmm.
not going to go wrong either way, I don't think. But it'll also be it'll just be a better way to be able to answer questions and actually run analysis a little bit, I think, which leads to beautifully some of your ideas. What I wanted you to do, actually, I don't know if you're able to share your screen and like what you look at, but what would be really cool, and maybe this one, if you can, if not, we could do it on another one. But what I'd like to do is just see how you find your ideas and like what you look at so that we can have a conversation about that. It'll give me ideas on how to help you look at stuff either with options markets or not.
Hmm. Um, well, I don't know how to like I look at the charts, but I don't know how to pull those up without like pulling up my portfolio.
Yeah, can you could pull up the charts in what is the fucking thing, trading view or whatever? What's that fucking trading view? You can get a That's what I do sometimes. You can pull up a free account. So go to tradingview.com. It's just easier if you can drive a little bit so that I can see what you're looking at and how.
With how quickly the market changes, my ideas have changed also since last Friday. I don't know if
I
anybody
say
else
that's
feels that
normal.
way. Yeah.
I would say that's normal. Yeah, because there's also been actually some pretty profound differences.
All right, I'm in TradingView.
Perfect. So then what you could do is you could pull that browser out into its own window so
Mm-hmm.
that you can share just that window.
Share.
Yep. So you'll hit share, and then in screens, there's the top section, which is entire screen. You don't want that. Go down to the next section. You'll see application windows, and then you'll see it there. So click the one that has trading view, hit share. Literally perfect, bro. So now at the very top in that search bar, you could just drop the tickers and then you could walk through, generally speaking, like what you're looking at, how, and why.
All right, well, the first thing that basically changed my entire view of like what stocks I'm interested in now, what trades I'm interested in now, was the VIX getting down to such a low level. Like, obviously, we had this spike in all of the volatility last week. So, like, I was interested in, I chose Amazon last Wednesday stream, and I was interested in a lot of the tech stocks. But now that VIX has like crushed all the way back down into the 15s, I feel much less inclined or excited to like put on any kind of either growth or tech or like high risk, high beta stock at this point. Now, is that how you would feel too, seeing the VIX like get back to such a low level? Like in my head, I almost feel like we have nowhere to go but up over the next couple of months. We're in September, October is like typically weak and in a midterm election year.
Yes. Overall, yes. The trick is with volatility and with VIX is it can cluster in specific spots for long durations. But as you added a little bit more color around your expectation with midterm elections and whatnot, I I definitely would agree more than not with that. Yes.
Hmm. Okay, so some of the trades that I'm interested in, building off that midterm election thing, is I expect a lot of negative headlines surrounding like the AI industry to flare up around them because the general population basically hates AI. So I think politicians will obviously lean into that. So I'm not as interested in like any of those semiconductor AI infrastructure type plays. Like I think they could have either extended chop periods or longer or even like lower lows than we've seen already. But one chart that looks super interesting right now is GLD to me. I don't really like how the chart looks in like this view. I feel like it's less, you can see it less clearly, but like it's breaking out of this downtrend that it's been in ever since it peaked last year and it had some strength and it's breaking out. And I feel like it's the perfect like rotation vehicle for a lot of people that um, have either made money in the market in the tech growth AI trade and like want to park it somewhere that feels safe over the next couple months. Um, Obviously, we know the government's going to keep printing money, so gold is like going up no matter what over time. But I really like how the chart looks of how it's breaking out, and it's still got a lot of room to go left to all-time highs still.
So the first question whenever I see something like this is what is your technical analysis based on?
Um, in terms of the chart,
Yeah, you say that you see it breaking out, so you like this, but what what about it breaking out and how do you arrive at that decision?
I don't know if I could like draw a line in this view, but just like
I
you
think you
could
can. Left hand side, left hand side. You see the little crosshair and then underneath it, the go up. Yeah, that thing.
so you can draw a pretty clear line from like where it got rejected over and over the past couple of months as it was downtrending, which makes perfect sense because it went on such a tear and it was kind of crazy to see it actually rip that much last year. But this is the first time it's broken through this downtrending line. And I'm not even like a super technical chart person, but I think just having, I watched stock charts like every day for years now. I've picked up, the basic bullish bearish trends you see in charts. And I think this is a really in combination with like the macro thesis, seeing this on the chart, um, I think it looks really good. You could even draw like another, like it was a descending wedge looking
So
pattern.
is there what is the perspective on you just said a descending wedge? So what what happens in a descending wedge?
In terms of what's represented on the chart, like
In terms of probabilities. Like if I see a descending wedge, what are the probabilities that a thing goes up? What are the probabilities that the thing goes up and continues versus comes back down? That kind of thing.
that I do not know.
It's an important question. So one of the things that happens in an, I'm not saying you're doing this here, but one of the things that very regularly happens in analysis is we purposely look for things that support our idea. We analyze something in a way that supports our idea. And one of the things I noted is on that top downward sloping line, like even as you drew that, you said, it's attempted to get through it a bunch of times and it was rejected. And I see twice, definitively twice. So it generally follows the line. And I'm not saying that it needs to touch the line, but I'm just using that as a general example of how our brains like to do that. So what I would think about with this specific scenario and technical analysis in general is I have no problem with it, but it needs to be backed by something. We need to have some type of research that gives us some type of idea. And it's not so that we play the probabilities, right? Because there's other qualitative things that you are overlaying here, right? You're saying, well, based on the printing of the dollar and stuff like that, like that's completely valid. And that doesn't necessarily show up in the chart as you're drawing it here. But what we should have is an objective understanding of how a specific thing tends to behave that becomes part of how we analyze it. So an easy way to do that is you could do it in Excel, you could do it with whatever, but you can download free GLD end of day price data from Yahoo Finance or some shit like that and give it to Claude, I don't even think anymore you need to give it the data. I think most of them can pull directly from fucking Yahoo Finance via APIs. And you could literally be like, yo, first, help me define what a descending wedge is. Then I want you to go back through the last 20 years of history in GLD and explain to me how many times it had a descending wedge and what was the subsequent outcome, right? Like that's completely reasonable. And that's not something you need to do now. That's not something that's important in the beginning. That actually becomes way more important later. I'm just planting a very specific seed here that when we do analysis, especially technical analysis, we just have to be super careful on what our brains are trying to do and how predictive something may or may not be. So the qualitative part, I mean, that is what it is. We can analyze a lot of that too. We can say, well, how much does this thing tend to drift up as each 6 months or each year a certain amount of dollars are printed, and you can come up with something pretty specific for that, but I wouldn't get bogged down in those details. This is all just general information for it to swirl around. This is fine. Like there's nothing wrong with this. And by the way, this is actually a real thing. So when things have breakouts like this, even after they follow these really big down moves, a lot of times there's a continuation depending on the asset class, but that's not me saying it because I think that. It's because I've looked at hundreds of thousands of versions of this. And it is a propensity. I literally have an archive of different stuff like this that tells me the actual probabilities by asset class, market cap, all that shit. But the short of that is like, this can be something real for sure. So let's move on then and think about so walk me through how you would build a position in here. What would you be thinking about?
Typically, I would just buy, a small portion of my portfolio in it, and then I would just continue to monitor it and either take profit or risk assess if it's going the other way. I'm kind of very just like actively monitoring and then like reevaluating how I'm feeling about things on a pretty continual basis.
Okay. And walk me through the way that you would like build a position in GLD. Like, would you have gotten in today?
My typical style of investing is not really buying when things are like actually going up. And like I don't get excited to buy something. Like I think I'm pretty contrarian and like I like
I hate
buying when
that.
sentiment is very weak.
I hate that. Oh man. We we have the laundry list. I literally have fucking AI companion running, and on the last one I had it give me a summary, and I was just like, we got some shit to work on. And I can
I'm not a
only
trader.
imagine, I can only imagine what this fucking thing is going to tell me after this one. So, contrarian sounds real cool. It doesn't fucking work well. Like that is what it is. I have specific contrarian strategies for sure. For sure. A lot of times for me, it's based in reversals with respect to a momentum factor and stuff like that. That's fine. But I would be very careful to label or let yourself adopt that as like an identity or like part of your trading identity, because it naturally starts to skew and constrain the way that you look at things. For example, if you just go to the left side of that chart where, it like starts to break out in September,
Hmm.
if you wanted to be, yeah, further left. Yeah, right there's fine. Just, yeah. So if you wanted to be a contrarian, then you would say, well, no, I'm not going to get in here. I'm going to wait for a pullback because it just gapped up. And then what happens? You miss a run from 320 to 500 because we're a contrarian, because we don't buy when something, right? It doesn't mean anything. It's fucking fake. So there's nothing wrong with having specific strategies or profit mechanisms that are based on reversals or a contrarian sentiment. Like that is okay. But I would just be very, very specific to not identify as that. I would say something more so as I have certain contrarian strategies that look for low sentiment, and then I try to play the other side of that. But I would not say I'm a contrarian. And the reason why it sounds so trivial, but the way that we speak and classify ourselves, your brain is actively trying to make that true. It wants to realize the thing that you're painting for yourself. So then that will influence everything else down the pipeline, whether it's a lot of influence or a little. So it's just a small thing in general. When you're thinking about trading writ large, I would always bring yourself back to the, like, I don't even consider myself an options trader. I really don't. Like, if somebody says, like, what do you do? I literally just say I'm a trader. And then they say, oh, like a day trader. And then I normally would say something like, yeah, like that's part of what I do. But I don't marry myself to individual asset classes. I don't marry myself to individual ideologies. There's stuff where I'm long, short, buy premium, sell premium, near DTE, far DTE, all of it. I'm cool with it all because my job as a trader isn't to have an identity, it's to fucking make money. So that's my identity. Whatever gets me to make money. That is what I would start to press on you, even as you talk about your style and your preferences.
Hmm. That all makes a lot of sense. One thing I want to ask you is, so like I feel like people will have a natural inclination to whatever style of investing or whatever
Mm.
is right for them. I don't know why it is, but that just seems how it is. It feels like there's infinite opportunity in the market, and you should almost become a master of like your what feels right to you or is innate to you versus going out and trying to just like capitalize, because there's plenty of opportunities. I feel like it's like there's no shortage of them. How do you feel about that? I don't know if I'm articulating it properly, but
I follow completely. It's something that I wrestle with a lot in my conversations with people. I would do my best to lean into your process based strengths and proclivities, not stylistic. If somebody says to me, like, hey, Eric, I really want to outperform the market, they see my CAGR, I have a 30% CAGR since 2007. So they'll say, like, oh, damn, like that looks really good. I want that. But, I don't like undefined risk because it makes me uncomfortable. But, like, fuck your comfort. Too fucking bad. Right. Like that's part of the thing that goes into this. Or they'll say things like, I don't like being short the market. I have moral issues with it, or I just think the market tends to go up. Also, too fucking bad. Like, too fucking bad. If you want to be able to make money during bear markets, guess what you need to be able to do? Trade the other fucking side. So I think that there's truth to it, but I think it really, really needs to be wrangled and controlled, because otherwise people will say things like, oh, like I only prefer short-term holdings, or I only prefer day trading because I don't like overnight risk. And we go too far. And the market doesn't give a flying fuck about your preferences. It does not care. So I would say yes, within good taste. If you say things like, I really like analyzing companies and doing a ton of research, Well, that might lend well to like a value style investing approach. That could be just fine. You're still going to leave a bunch on the table, and that's okay. But like, that's a way that you can lean into an actual strength versus just artificially saying, I like X, and then trying to operate within that capacity.
Hmm. One of my, feel like major weaknesses is I don't think I have a clear defined strategy or like structure. I feel like I just take in like a million different inputs since like I'm saying like so I make content around the market, so I'm following it every day. I'm looking at all these charts, I'm looking at all these posts, all these stories. So I have like all of these inputs that I feel like I have like a good general sense of the market, but I don't have like key like this indicator, this indicator, this indicator, like this is when I make a
Mm-hmm.
trade, this is when I'm interested in a stock type of thing.
Did you happen to watch the video that I released on Sunday?
Uh, I don't think so.
It's about Edge. That I would assign to you as homework. It's long. It's about an hour long. It's a bit of a live stream that I did, but it's that literally answers that in a nutshell. Because the thing is, like, we don't need more information typically. We have tons of information. But what we need is a defined edge. And that video will probably change the way that you think about it. And that'll be the direction that you go over time. Because part of what I'm actually doing when we're doing these and I'm asking you to show me things is I'm profiling you. Like I'm getting a sense of how you think, why you think certain things, how you make decisions, and all of that is kind of what I use to try and direct what would make sense for you going forward, trying to strike a very distinct balance between leaning into your strengths, but also shoring up small gaps and weaknesses that we need to tighten up. And it's all based on like my perception of how you think and do things. So I would say specifically with building a process, it'll actually become way easier when you understand the nuts and bolts of what you need to do. So I'm going to drop a video in the chat. This one is the video from this Saturday or Sunday. And then there's another one. Well, there's actually a couple. Um, I'm not going to hurt you with the research process yet. I am going to give you this one, the outlier strategy process video. You absolutely need that. It's just like a framework on how to build things. And then I'm going to give you one more video, which is about, it's like a couple examples of strategies, like things that things that actually do something. So you need this one and you need this one. So those four will be your homework. The preview for those, don't even worry about it. We will be able to add a literal defined process around it, and it's not difficult. So don't even worry about that.
Hmm. Shall we move on to another chart?
We should build a trade here first.
Okay.
So give me what you think is going to happen and how it might look.
I would be interested in holding this, not back off to like the blow off top, but well, in my investing brain, I would just buy it because I'm kind of like not so interested in the growth areas of the market, and I think there's going to be probably like some volatility over the coming months. So I would just
Okay.
buy it and sleep well knowing like I feel like I'm confident it will do better than the market, especially the way it looks right here. Um,
Okay.
but I would
Over
probably not get greedy and like try to like get back to all-time highs or something.
over what duration?
I think probably through like it depends on like how this all of these inputs that I'm getting at the time, but probably at least through like the middle of September.
Okay. And where would you consider yourself wrong?
Probably if it dropped back into that channel of the that I just drew.
I like that. Okay. So now let's talk about different positions you could put on. If you were to put on a stock position, you already said that you wouldn't technically do it today because it's up. So, what would that, did I get that wrong?
Um, I would probably not do it today, seeing it up like that. I would see the
Okay.
other thing that I feel like a lot of breakouts like this do a lot is retest the like trend line. So I would try to get a little greedy. I like trying to get greedy and trying to see if I can see it retest and maybe buy there.
Okay. And then if it doesn't do that,
I would just say there's plenty of opportunities in the market and I'll be on to the next one type of thing.
okay. So we'll hold on this one. What I want to do then is bring up another one that you would have entered today. And then I want to build a position. Ideally, we can get to like 3 of those or 4 of them, knock them out quick so that we can build a little bit of a portfolio for you.
Okay, this one is probably similar to gold, but I've been watching your videos and this one is interesting me because you've mentioned something about post earnings drift, I believe. And
Post
they had
earnings announcement drift.
yeah, they had a good earnings reaction, but then they also dropped from like the peak of the earnings move. And I really like being in that defense sector at this time with my overall view. And I really like the chart as well. And the fundamentals, like I feel like a lot of these types of companies are super frothy, and obviously this one was, but it's pulled back a ton. So,
So
um,
you seem to like things that have big pullbacks.
um, if I'm excited about the future of the company, yes, I would like rather buy on a discount.
Okay, so that's another mental disease we're gonna like work on fixing because from like a trader's lens, it we don't care. Like we don't care discount, surplus. Like if we're buying something, the only thing we care about is do we think somebody else is going to pay more for it? Like that's it. And you want to be really thoughtful about how you overlay different types of styles, right? Because like discount is value. Value is super long term and it's based on growth of companies, a lot of times discounted cash flow calculations and shit like that. I'm not saying that's bad, but it's just a completely different style. So with stuff that has pullbacks, normally there's a reason for it. And there's a really important market effect that you want to become familiar with because I'm going to talk about it a lot because it's really, really dominant. It's called momentum. Momentum is a legitimate profit mechanism that you can monetize. It has alpha, it has edge, it's real. But momentum, normally speaking, is pretty good for finding directional stuff in different durations. Now, what you're showing here is also quite reasonable. This is what I would call a reversal. If you think the fundamental picture, the overall status of the company, all that kind of stuff is still about the same, but it just got frothy and then sold off, like that's very reasonable. But this is another type of study, and I will literally do this one for you. But what we need to look at is the follow on price performance for companies that are up at least what, like 50% over the last, what, 2 years or so?
I think this is what George has said a million times to me, which is like the best predictor of a stock going up is if it went up in the past year, basically, is what he says.
It's a fair one. Like that's momentum. That's
Hmm.
exactly what momentum is. So walk me through how you would profile this. And then what I'm going to do is I'm literally going to do research for you. And I'm going to look at a basket of things that pass the filter that you're using and literally show you like this is how these things tend to do. So first thing is let's define the universe. This looks mostly what like small mid cap. I don't know what this company is, but
Yeah, it's like
like
12
what
billion.
market cap? You said, I'm sorry?
It's like a 12 billion market cap.
Yeah, okay. So, and in general, when you're looking for these kinds of plays, would you say that they're about the same as this, or normally like bigger companies, smaller companies?
I feel like a chart is a chart almost, and I don't really care about
Okay.
the market
So
cap.
so you're market cap agnostic.
Yeah.
Okay. And when you see things have gone up a lot, what is the relevant look back window that you're using? Because in this case, you're saying, Kratos went up a whole lot and then it unwound a bit. So what's the time frame that you're looking for something to have gone up a lot?
Um, Honestly, I don't the time I was actually going to bring up a time frame, but it wasn't the part where it's going up, it's the part where it's going down. I kind
We'll
of
get there.
okay. So
We'll
I
get
don't
there.
really
But
yeah.
in this one specifically, you had said it's gone up a lot, it got frothy, then it came down. How do we define that? That first part, gone up, got frothy. Like what is that?
Um I would just talk about percentage gain and also just like when you see a chart and there's literally like no dips, it's like a straight line up like these movements.
Over what time frame?
I feel like it could almost be any time frame. It could be like short if it's just like a month move, or if it's longer duration, but it's like the same style chart, whereas like no dips, just like a straight up. Um, I would say
So the
it
other
probably
thing
have
though
to
is
be a
that
year or less though.
switch that from a weekly to a daily in the top. You see where it says W? Do you say W or W?
W.
Yeah, W is normal. Go down, go down. Yeah, click day. And then you have to slide yourself back a little bit because I think it's going to put it back to a week if you do that. Yeah, it's super annoying. You just have to pinch the bottom. So turn that back to a day in the top.
Oh, okay.
Yeah, and then pinch the bottom.
Is that enough?
No more. So this thing had like actually pretty big pullbacks.
Well, this
You were
one just
just
got on
looking
my
at it.
radar recently.
Yeah, but I'm just saying like you see my point though. Like you were looking at a weekly aggregation, you said when it goes parabolically up like this, but this didn't do that.
Mm-hmm.
So it sounds like, can you click, get the line in the top left? Yeah. And then click right by 2025 to the left. Yeah. Click somewhere in there. And then go to the peak in, no. The one in July first. July to the right. Yeah. Bingo. And then hover over that. Does it give you the details for the move? It doesn't. That's fine. So it went from what, 35 to like 72. So it about doubled. And then, so if you saw that move by itself, not the rest, but that move, is that a sufficient move for you?
Sufficient meaning what?
That you would say,
Profit.
like, yeah, okay, this has gone up a lot. And like, let's just pretend that that top part doesn't even exist.
Mm-hmm.
Let's pretend that it made that up move. It just made a down move. And now it's going back up again. Like, is that move there enough for you?
No, it wouldn't look interesting to me.
Okay, so you need like over 100%.
I think the time duration component is also almost more important to me than the percentage for the like consolidation period.
So emphasis on strength of move relative to the time frame.
Hmm. because
and
I
compressed is better.
I feel like sentiment gets removed more so with time than with percentage pullback.
One of the cool things that's going to happen over our time together is that you are going to stop saying, I feel anything.
The data shows.
Exactly.
Yeah.
So right now you can feel because we don't know. You're going off of your intuition, which is fine. Okay, so emphasis on the strength of the move relative to the time frame compresses better. And when you're looking for a pullback, right? When you consider something frothy, how much of a pullback does it need?
It would be case by case, but I would probably want to at least get like a 20-30% pullback, I
Okay.
would feel like.
20% pullback over what duration? Over at least a week, two
We'll
weeks.
see. I don't know. It's so case by case for me because like I bought the dip on like the Bloom Energy and NBIS recently, which was a very short, quick pullback, I felt like, and that final day it was like capitulation. Not I feel like. Um, but I approach every situation independently in my head at least.
You can't trade like that. That's not a thing. Because think of what that means, right? You were talking before about not having much of a process, and that makes complete sense, doesn't it? Because if you approach everything as a unique unicorn, it means that the only thing that you're attempting to do is trade what you happen to see at that time. And let's say you do your analysis first thing in the morning, then maybe you do your analysis on other names midday, then you do some of your analysis here at, are you on the East Coast?
Hmm.
So here at 9:30 your time, right? Like even your analysis over those 3 periods is going to be fucking different. So it doesn't mean that you need to have everything completely outlined and defined and automated. I don't even do that. I am very much a discretionary trader, but things need to have bounds that are reasonable and things that we can actually research. So one of the things that we need to get you in the habit of is literally this, right? When you see something that looks interesting for whatever reason, it's tracking it. It's saying this thing looks interesting because it had blank going on. And then what we do is we can look back over the breadth of evidence and we can say, well, when we see similar things to this, what do we think? Like, how does this thing tend to do going forward? Because then you'll be able to objectively say, like, yeah, okay, my brain is actually picking up something and it's picking up a reversal or it's just picking up something. Your brain is a master at pattern recognition, and it's good and bad because sometimes it'll see shit that's not fucking there, but it'll also see things that are there. So this is a way for us to get at an objective answer of like, is it actually seeing something that's there? Or is it just making up a pattern that it wants to see?
Hmm.
So to that, it sounds like the pullback doesn't need to be any sort of duration, right? But it does sound like it needs to be multiple days. Like if something made a 20% pullback in one day, would that satisfy the need?
Okay, so I think the duration of the pullback is also correlated to like the interest I have in the duration of holding it. So like if something pulled back 20% in a day and I bought it, maybe I'd want to hold it for a few days or a week. Whereas in if I see something like this, like maybe I want to hold it for a few months or even longer.
Okay. And when it starts to post its reversal, go scroll to the right so that we can see what what do you look for in your reversal?
Well, this one had earnings, so it had a good earnings move,
Does
and
it need to have a catalyst?
I think yes, it will always have some type of catalyst, even if that's
Okay.
volume or like anything, even if it's something small. Like
Okay.
like it wouldn't have to be like a news story necessarily.
And so it needs to post a reversal. What move satisfies you? So like this one, it gapped up, but it's not above some of the left resistance, but it's above some of it. So what would help me here is zoom in more. Okay. Which of those left support lines are like peaks? Not all the way over there. Sorry. The ones closer. Yeah. Which one of those does it have to be above for you to say, like, this is a good change in direction?
Um, I wouldn't even typically look at those to like
So,
make.
okay, that's great. So then does it need to have a gap?
No.
Okay. And so then from that base that you see down at the bottom, how far up would it need to go for you to say this thing's reversing?
I would probably draw a line on like these recent things and see it break out of that. And just to point, like to hit on your gap point, I feel like gaps are almost bad because from what I've seen, most gaps tend to get filled eventually. So you kind of are like leaving a hole there that might need to get filled.
We don't, yeah, we don't care about that because as long as that's what stops and shit are for. If something gaps and it's showing strength, then we like it. And because we're not going to fucking hold it full round trip, we're going to take as much out of it as we humanly can. And then we're going to exit, maybe get back in, maybe not, right? That's all obviously a little bit subjective. So you would draw a descending trend line over what duration?
Probably like these right here.
That
And I wouldn't actually, if I was doing, I wouldn't actually draw it. I just kind of look at it and like see it, you know.
Sure.
Yeah.
But what duration?
I guess that's pretty short. That's like a, I can't see that. Is that a
Zoom
beta
in more.
artist?
Yeah, exactly.
More.
Yeah, it's fine. So it's like the end of May, beginning of June into August. So that's like 3 months.
Not enough. I
I'm
feel like
asking you.
I feel like you can go crazy with like a million lines on a chart, and this one, I feel like I gotta stop saying I feel like a lot of
Yeah, I'm
the
really glad
trade
you feel this way.
a lot of the investments I get interested in, they have like an overlapping confluence with my general macro sector market overview, and
Sure.
then the chart will confirm it or make it interesting, but there always needs to be that underlying, it needs to be have a place in that macro type of view.
Sure. That makes sense. That's something that if that exists, you need to track it. And it needs to be something you actually define. It can't be like today I like defense and then tomorrow defense goes up and you're like, oh yeah, I knew I like defense. Right? Like today you need to be like, I like defense, I like agentic I like blank, right? Whatever actually defines the macro thing that you're looking at. And actually, I would say, do you have your trade log that I built for you pulled up?
I don't, but I can pull it up.
Yeah, grab it.
I think I need to do this. It only has one trade in it. It's that one, right? The
Well,
Amazon
it
one?
has one closed trade because you don't have anything on right now. Okay. So I just added a tab at the bottom called macro themes.
Hmm.
And all you need to do, how many themes do you typically overlay at a point in time?
Prob well, there's long term companies that I'll just buy and hold, but then shorter term, yeah, probably no more than like five max.
Okay. So then what you need to do is today after the stream, you need to fill in what themes you think are viable for whatever reason right now. And we need to track it. Does that make
So why
sense?
it's interesting and how long I think it'll be interesting for type of thing.
I don't even really think it matters how long you think it'll be interesting for, because my assessment for you is that you probably would change based on like what the market is doing. So you might say like I'm really interested in defense for the next year, but then if defense was shitty tomorrow, you'd be like, "Oh, well, I'm not interested in defense anymore." So the expected duration doesn't actually matter, right? Because if you change your themes based on what conditions are going on, then you it's really it's there until it's not, right? It's more conditions based, less time based. So all I would do in here is I would literally just in the themes throw in. So you said that you like defense, right?
Yeah.
So you said long defense. And what I would actually do to make this easier to do research on is I would add a directional tilt with the theme. So this would be like theme 1 is defense. And then theme 1 direction is upside or just up for easier use. And then so on. So that the reason why you want to split it this way versus having like word vomit in these cells is so that you can actually do data analysis on it, right? Like if you have a shit ton of words in here, then you have to like go through the ass pain of writing these complicated formulas that are pulling a certain number of characters from the left and from the right in order to, actually build research. So this is doing that for you.
So I should probably stick to the actual like sectors that are named, right then? I shouldn't just put in any, I don't know exactly how to classify some things, but I should make them fit into like a specific sector.
If that's how you trade. But that part doesn't actually matter. What you're explaining in the thing before, though, is that it seems like it's important to you, right? You were just saying that it needs to align with your theme.
I was just thinking about for like the data analysis after, like you were saying, so it's easy to search through it. You would have to have the same
Yeah, yeah,
like
yeah. No.
sector.
I agree with that. What all I'm saying though is I would do whatever you do, like whichever strategies or structures or whatever that you actually care about the theme, then yeah, definitely capture it.
Hmm. Should I do that daily or weekly or just
Whenever it changes. So
okay?
whenever you say like, oh, there's a new thing that I'm interested in, then you should add a new date
Hmm.
and just add the new one, whatever it is. And then whenever you decide that you're done with one of your existing themes, so let's say tomorrow is 6 August, and let's say that you think that you're done with the defense theme or it changes, I would then just write something like flat or exit, right? So then you can easily again do math and have it tell you based on a specific day how long were you into that theme, how many trades were instituted during that theme, and so on. So I would just do it whenever you're analyzing a trade or you're putting something on and you're like, oh yeah, this is like a new theme that I like. Then just throw it in there.
Oh, I like this. I wish I had this for like the past 2 years or 3 years. Yeah, that's
One of the
cool.
things you'll note that I'm really, really strict with is tracking things. And it's
This,
because,
I mean, this makes
yeah,
perfect sense. Like in the
yeah,
gym, I have like a log of like my workouts. Like it makes perfect sense to log everything you're doing to keep track.
yeah,
Yeah.
it's exactly right. And it's because it's super important. And it's because it's how we conduct objective analysis. So I would fill this in when you're done and let's flip back over and let's get a couple trades built out. So I have the research built for this writ large. I'm not worried about the theme component as much just yet. I just want to see the effect. And it generally seems like it needs a reversal based on some sort of catalyst, and the stock needs to go up at least what amount? So what I want you to do is to, in August, when it posts that bottom, how far up would it have needed to go?
I get interested when it breaks through this line right here.
And what are the prices there? That's 44 to
50,
49. So what, like 10%?
15.
15? Okay. And are you using the open or the closes for these?
Uh, oh, I think I used, how do you
The
read that?
low.
The low for each? Because
Okay, so you're using the actual low.
yeah.
Okay, another general piece of advice when it comes to doing stuff like this, again, you can always do whatever you want, but more often than not, you want to use the body of the candle, less the wicks.
Hmm.
There's specific instances where the wicks make sense, but the bodies of the candle, the open and the close, specifically, that's like the voting machine. That's where the market ends up saying, like, this is what this thing is worth at the end of the day today. Like, after everybody does whatever the fuckery that they do during the day. So, just in general, I would be more interested in bodies than the candles, but the candles can have use. So I have our research outlined. Let's build some options trades. So walk through your your disposition, and then what you can actually do is inside TradingView, if you open up another tab, you can literally open an options chain. So just duplicate the tab. No, up top, like the actual.
Oh, how
Yeah.
do I duplicate?
Duplicate the tab. I don't fucking know, you're on Mac. I would right click and hit duplicate.
How,
I don't know. You're the one that's using a fucking
I've
Mac. There
never
you go.
duplicated a tab before.
That's crazy. And then in the top, I don't know how to find it from here. I would just go. I would type in options or go to TradingView, like the main page, and then go to products options.
You like my username?
There we go. CG. It's perfect. Oh yeah. Click dark theme for the love of God.
Oh yeah, I'm a big dark theme guy.
Go up. Yeah. Oh,
Whew.
that's way better. Yeah, that's way better. So
All right,
just go
where?
to tradingview.com. The fucking chat will know how to do this. I don't know how to do. Lauren says it's under file. Day late, dollar short. No. Go to the three drawdown bars on the left hand side, not your watch list. Left hand side, yeah. Products up top, products, and then options, second from the bottom there. Bingo. And then type in your ticker. I think it's KTOS. I think you might have to do, well, try it here. See if it works. I think you might have to do it in that little pull down on the left hand side. Yeah, go back. And then you see where it says ES1.
Mm-hmm.
Yep. And then go to more instruments at the bottom. Bingo. And then type it in here. Perfect. So now you have the options chain. So you don't have to look at anything in here just yet. I want you to talk to me first about what you're expecting and that sort of thing.
Well, I'm expecting the stock to drift higher over the coming months. I don't have an exact percentage amount in mind, but it's an area I'd like to be, and I think it can easily just drift higher, is my thought process.
And how, like, what's your upside price target?
I'd probably say, I mean, I don't have one, but I'd probably say like 65, 20% gainish would be feel good.
Perfect. So if you were then to just brainstorm an options position for the portfolio that we're trading for you, we're talking like 25K, right?
Mm-hmm.
Oh,
Oh, lost your
sorry. No, I was yelling at my dog. Um, Perfect. So how long would you expect to hold this?
Um, well, I wouldn't want to hold till the actual expiration, right? Because then you're running the risk of like it going to zero.
Sure.
So I'm expecting
Just
to
don't
hold
worry about
this
the DTE selection. Tell me how long you expect to be in the trade.
2 months.
Okay. So for expiration, you see where it says next 30 days, open that up. And let's go to the probably November or January. Click. I don't know if you can click both of them. Yeah, perfect. Good. And then for strikes, you need way more than 6. So open those up. Left-hand side. Yeah, click that. Just do all strikes. Okay. So there's a couple different kinds of positions that we can build here. I'm going to pull it up on my side because it'll be a little bit more efficient for me to like walk through the option stuff. But I want you to look on your screen as you do this. So, because again, until you get whatever platform you're going to be in, like this is where you'll be looking at the options chain or, you know, Robinhood, wherever you would look at the options chain. That's what I'm looking for here. So I'm going to share my screen.
TradingView seems pretty decent for like this is just a free look, but what are your opinions on this just to like mess around and look at stuff?
I don't use it. So I actually have quite literally no idea. I only use it for random shit like this. Like where, you know, like you don't have your stuff set up to pull up your platform and, you know, not show your account data and whatnot. Okay, so in Kratos, we're looking, you said like 65, right?
Yeah.
For your price target? Okay. And then you said if it falls back in this channel, that's where we're wrong.
Hmm.
How far in the channel does it need to go?
I think I would just need to see it close inside of it on the daily.
So a close anywhere like 50, 60 or lower.
Yeah. Probably
Okay.
if it was that close to 50, I'd probably like I don't know if you care about them at all, but like the psychological levels, I'd probably just wait to see it touch the 40s or like see how it reacts at 50
What
and
the
then
fuck? What do you mean touch the 40s? You mean,
like when it gets to like the flat 50 level, see how it reacts there and then decide if it's breaking through 50 or bouncing up from 50. I feel like psychological levels actually play it decent in how stocks move. I don't know.
so then so then where are you wrong? That because then it's not when it's in the channel.
Well, I lost the view of the channels. I thought you just said it was like $50.60. Was
Pull
the
wait, can you not see my screen? I'm sharing my screen.
Oh no.
Pull my shit up.
think I have to pull up YouTube then. My computer's gonna go bust. I have a million tabs open here.
Don't forget to like the stream while you're there.
Come on,
Like,
man.
share,
I already did
subscribe.
that.
Like, share, subscribe.
You're gonna hit me with an ad though? All right, here we go.
I never do ads during these. I literally have them turned off.
YouTube's got to make their money, Eric.
Fucking you. So you're saying if it's 50 or lower, sub 50, that's where you're wrong. If it closes sub 50 or lower.
Yeah.
Okay. Create alert. Close. Okay. Ryan says, I get ads on your live streams. There's literally no way. I straight up do not have. Oh shit. I literally just hit insert ad. So you guys are probably going to get an ad right now. But I have it set to manual. Ryan says, like, when we're waiting for you to show up and when you first come in, feed me an ad. Yeah. So I think like before and after, YouTube will do it on its own. And then I also think if you watch the recording, you'll definitely get ads. But yeah, like during the live stream while it's on, there's there literally are no ads. Ryan says, if I open it in the middle of a live stream. Yeah, that makes sense. So it's probably feeding them to you like when you're first tuning in. So it's not actually during the live stream. That checks out. So let's take a look at what this would look like. So we're at like 40, 80, and 65. So here's what I'm thinking for you. There's a few ways that we can take this. First thing is I actually need to see where the liquidity is. And what I'm doing is I'm actually using this tool down here to see where most of the liquidity is. It's actually really useful. Then there's another way that I can observe the liquidity for things. And all I do is build like a quick profile of the underlying itself and how the options chain is actually laid out. And I'll show you what I mean by this. So I'm looking at this tool. Again, this is within my own tool, and this is for Kratos. And what I'm looking at is where the open interest is. So I can see that the open interest is in 21 August. People are trading it in the front. And then the next best bet is out here at 21 Jan 28. So this term. This is generally speaking where you're going to be able to find liquidity. So it immediately tells me like where we need to go in order to find liquidity for these. You're not going to be able to be like 18 SEP, like you're not going to be able to be in most of these other terms. So let's take a look then at 15 Jan. And let's take a look at some ideas. The first thing we could do is literally just get an at the money call. And if you got something like this at your price targets, you're looking at 65 and you're looking at like 49.80. You would be making 481 and then risking like 308-ish. So this is one trade that you can put on. This one, you are paying theta and you're paying about 4 cents a day. So your options are going to erode at about 4 cents a day. So it's pretty slow relative. The other thing that we can do is we can look at something that's further out of the money and we can get 2 of them. But that's going to increase your overall data cost. So to start you off, I literally think we just build this as kind of like a stock replacement. That's all. So I say we do like the 65s. Those are fine. Sometimes I'll go deeper in the money and whatnot. We can talk about that in a little bit. But what would you say your max risk, your max loss tolerance is what, 250 bucks for it to be like 1%, right? On a 25K account. And this puts you at like 308. So I mean, you're pretty close. It's a little bit over, but that's probably fine. So let's start putting this one on. One thing that I typically would do is actually turn this into a ratio call diagonal, but because we can only put on one contract, we can't. There's just not enough. So this is one trade idea. Another trade idea that you can do is you can sell a put spread. So with the put spread, you're risking 383 to make 117, but you have a pretty high probability of making that 117. The way to think about making the decision between the vertical spreads versus the long option is your preference for uncapped upside. So if you told me, Eric, I have a stronger opinion that this thing is going to go up pretty significantly, which it sounds like is the case for you, I would lean towards the long call. If you were saying, I simply think it's more likely to remain above this level than fall back in, then I would favor the short put spread. So of those, I assume the long call is probably what you would want, but what's your opinion?
I think I agree. I feel like I expect it to move higher, but what are the actual probabilities of both?
So the probability of you touching the 65 is 70%. But remember, you don't need it to actually touch the 65. You just need it to go up before.
Hmm.
And the probability for the 18 SEP, the probability for your strike to be in the money at expiration is 38%. So you have like a 62% chance of making this.
Yeah, I think we should go with that one then.
Got it. So I'm adding this into your trade log. I'm going to do this one. And then let's do just one more before we sign off. And I want you to do the next one. I want you to input it so that you get a sense of how to use this thing. So this is based on the defense theme, right?
This
Is that
exact play?
accurate? Yeah.
Yeah.
Okay. And let's say that we're going to get into that long call and will be something. I don't think it'll be 9. Yeah, it shouldn't be 9. We'll probably get in for like 840, I would guess. So your strike here is 65. Your delta on those 65s is like a 49 delta. And the premium you're going to pay for that, I'm going to say is like 840. So your value at risk, the total amount of money that you can lose in this is 840 bucks. But the actual trade risk, as we've defined it, is more like $308 or so. So there's our first trade. Now, find one more that you're interested in, and you can actually explain it's sharing your screen now. You could grab the next chart that you're looking at, and I'm going to grab a water really quick so you could talk to the chat about what you're seeing, and then I will be right back. But you can let them know what you're seeing.
Hello, chat. Wow, I get to command the Outlier trading stream on my third stream. Wow, Eric has a lot of fakes. Do we got any things you guys are interested in looking at? Honestly, I don't know if you can even go long the VIX because I've never even tried to trade the VIX before, but I feel like that is the one that I have a lot of confidence in as well. I wish I could share maybe I can share the full list of trade ideas that I sent Eric to you guys in the chat. Let me try to do this. Let's see if this works. Oh no, it didn't copy the right thing. Maybe I could do it on if I join on my phone. GLD. Wait, I'm gonna share the full list of ideas I had on in the chat on my phone. Just one second. I feel like I like the VIX one. Here we go. That's the full list of ideas for you guys that I sent Eric before the stream even started. It formatted a little weird, but yeah, I really like the gold play with the lack of interest I have in like the overall environment of like the actual tech landscape at the moment. I feel like it's a good
So is that where you would want to? You said you wouldn't get into it though.
the other honestly, this is my number one thing. I feel like the VIX is definitely going to go up, but I've never touched the VIX before. I don't even know if you could trade options on it. I don't know how it works.
You can, but yeah, that's not going to be. You could just ignore that for now. That's not the place to be.
Now, the VIX spikes and always goes back down. Is that like 100% trade? Because it will always go back down.
Yeah, it always goes back down, but the thing is, it's the same thing with optionality. You never know how long it's going to take, and the options market also knows that. So you're not really going to get any sort of like free lunch there. You're actually going to get way less of a move than you think you should. So yeah, generally a bad place.
Mm-hmm. All
Yeah.
right. If we're gonna X out gold, which is fine,
No, no,
because I
no.
know
We don't have to X out gold. You're just the one that told me that you wouldn't do it. But if you would, then
honestly, I
we
really
should
like
do
this
it.
one. I'm a value hunter. I feel like this is a ridiculous value for Ross, and I'd like to go short it. It's trading
So
at
you want
like
to
a
be short Ross.
yeah.
Rust. Okay. And what's the expected holding duration?
This one I would want to hold a little bit longer, I think, because it's a value-based play, so it's not so narrative or sentiment driven. It's just an overall I think it's going to have a reckoning at some point with the valuation. So probably 6 months plus, I feel like.
Okay. And is this you don't think it's going to go above this level, or do you think that there's like big downside potential?
I would be more confident that it's not going to go up versus big downside.
Okay. And that leads me to probably a short call spread versus some sort of long put style position. How does that resonate with you?
That was actually one of the questions I was going to have for you today. Like, if you have an opinion based, bullish or bearish, how do you decide whether you sell a put or buy a call or buy a put, sell a call, like type of situation?
The way is by understanding how options behave in like their traits, and then being more specific about what you expect to happen and then marrying something with it that fits. So that's actually the exact purpose behind that question I was just asking, in terms of like how big of a move you expect to see. Because if you expect to see a big move, then you would want the asymmetric gamma, you would want to be long the put. If you're not necessarily expecting that, and it's more so you just think it's not going to exceed a certain level, then a lot of times the short premium is the way to go. There's other stuff that factors into it, things like what volatility is. That's a really big thing that we're going to talk about probably in this one specifically, because I need to show you a few things about understanding where volatility is and risk premium. But this, because it's more level set, I would lean short vertical, and the whole volatility stuff doesn't really matter that much if you're short a vertical spread. because you're trading pretty narrow vertical spreads. So most of the Greeks are wiped out. You don't actually have a lot of Greek sensitivity with vertical spreads like this. It's more just playing the distribution. Make sense?
I'm gonna pretend that made sense. Yeah, there was a lot of
What? No, ask questions. What part doesn't?
um. There's just a lot of terminology I'm not so familiar with.
Yeah.
So it
No, it's perfect. Let's map it out. Let's take a look at it together. So I'm going to start with the short vertical spread. On these, you typically want to be a little closer in time. Like you wouldn't want to sell this thing so that it's out like super far out in time. You can always reestablish it if you want, right? Like you could put another one on. But when it comes to price, you can be short at the 270s or the 280s. I would probably go more so the 280s. And then you can buy the 290s. Here's what this does to you. I'm going to track it over here. So this is so we're looking at 5 August. We're looking at Ross. Spot prices 250. Strike. And all right. So we're looking at the 18 SEP, and we're just going to look at a one lot that'll actually probably be too big for what your account in the scenario that we're looking at here will be able to justify. And we're looking at short the 290s or 280s, my bad. We're short the 280s and long the 290s. So we're going to be, these are like 390. And then these are like 30. And your delta here is 0.23. Your delta here is negative 0.15. Your gamma, I'm going to ask you to explain the things that I'm doing right now. So just keep that in mind. I'm going to want you to be able to say like, are you long gamma, short gamma, long theta, short theta, that kind of stuff. This is 0.112 is negative 0.084 vega, negative 0.268. Vega is 0.205. Okay. So here's your position to start with. And so this is the strike that you're long. And then this is the strike that you're short. Or I'm sorry, I flipped those. This is the strike that you're short. this is the strike that you're long. So what happens with this is when you net out your position, you actually do not have much of a directional tilt at all. So you only have 0.083 deltas, 0.092 gamma, 0.03 positive theta, and then 0.063 vega. So what happens here is all of these lead to not having a lot of a Greek footprint, like at all. You don't have many Greeks at all. As compared to, so for example, if you get a $1 change in spot, that means that your premium is only going to move by 8 cents. That's it. So if it goes down by $1, you only see 8 cents. This isn't a big directional trade in terms of your directional exposure via delta. But what you are saying is that based on the distribution of returns, the way that Ross can fall like this, if we think of spot price as this vertical line, and then we think of a distribution, what we're saying is that we don't think it's going to exceed this specific zone. That's what we're saying. So we're not inherently saying that we think it's going to go down. This is a really, really common misconception for people that trade vertical spreads, is they'll trade it in high volatility and say like, oh, I'm selling the vertical spread because volatility is high and volatility is going to come back down. There's normally a ton of issues with how people attempt to do that. But that's not what's happening here. We're literally just saying we don't think that this underlying is going to go past this zone that we carved out in the distribution. That's all. So we don't have a big Greek footprint. We're not worried about delta, theta, gamma, vega. All of that is going to be pretty much a non-factor with a really narrow spread like this. All that makes sense?
Yes. What would having a big Greek footprint or not, like, what does that change in a trade?
It changes the way that it behaves massively. So, for example, let's say that you were trading a really wide vertical spread rather than it being 10 points wide, which if you have a 10-point wide vertical spread and you collected a $1.60 premium, what's your max loss?
Is it 840?
Bingo. Exactly right. So here, what we're saying is if this was much wider, let's say, and I won't use synthetic data, I'll use like real inputs so that you could see the actual stuff. And then let's actually improve our thing just a little bit, and we'll do the vol for the underlying as well, which right now this is like a 37% vol for 30 days. And what I'm actually going to build, and the reason why I'm doing this here, we actually have this inside Hugin, by the way. Inside this, you can literally like go through and play different scenarios with this exact kind of thing. So we can input the ticker's information, the different legs, and we can say like, if something changes, what does everything look like and what's the impact across all the different shit. We'll fuck with this later. But the reason why I'm doing this one with you now is because this one actually gives you a way to replicate it on your own, which you should do. The reason why you should do it is because it'll give you a pretty good series of data points and a better intuition for what you're looking at. So then let's say we have a couple inputs. So we have a change in spot, and then we have a change in ball. And what you can do is you can literally build your own little what if simulator. So you could say, like, if vol or if the underlying goes up by $1, what happens to all of these? And there's also, again, like a more detailed calculator that I already showed you that does literally all of this. That's this thing. So, anyways, back to this though, and without getting too far in the weeds on all that, I'm going to recreate this, but we're going to use a much wider spread. We're going to go to the 330s. So let's say that this is now 330. And those you're going to get for like 40 cents. Your delta on those is going to be negative point, or this is your long. So this is going to be 0.03. Negative. Oh, hold on. What am I doing here? Yeah. Okay. So this delta should be short. I think I flipped the deltas on the other one. Sorry, I'm blanking. We think it's not going to go up, right?
Yes.
Okay, got it. Yeah. So then I need to flip all these and hopefully not confuse you. Gamma, you're good. Theta, you're good. Big. So it's just the delta that I flipped by accident. Okay. So here you have that same delta. You're going to be short the 233, and then here you're going to be long the 03. Okay. Everything else was good before. So gamma 002. And then theta. Good. All right. So gamma on this, you're negative 2. Theta on the 0.26. And then vega, you are at 0.060. So here's what your position looks like. Your position at $10 wide. Your delta, so if the underlying goes up by $1, your position will go down by 8 cents. If you trade the wider spread, the purpose of the wider spread is for it to act more and more like a naked option. So you're actually trying to get it to act more and more as if this isn't even there. Doesn't even exist. And what this does is take a look at just your delta relative to one another. If the underlying goes up by $1, now on this one, you lose 20 cents. So like 2.5 times more sensitivity to a change in price. So this is what happens when your option has more Greek sensitivity. You have way more sensitivity to the variance of the underlying, both in terms of how price changes and then how volatility also changes. So with a narrow vertical spread like you have, you don't really have a big Greek footprint. They're offsetting one another because they're pretty close, right? So this one's a delta of short 23. This one's long 15, right? So like they're kind of close. They just offset one another. But when it's much wider, they don't really offset one another as much. You have one that's way more dominant than the other one. So what that does to your position is now your position is going to be way more sensitive to all of these inputs, way more sensitive. than this scenario. And that's also why, for a lot of people, when they're trading vertical spreads, they get upset because they're really slow. Vertical spreads are slow, they don't really do a whole lot. And it's because they don't have a lot of sensitivity to anything, which is, again, like, if you know what they are, that's not a bad thing. It just means that you're not really playing the Greek side of the equation. Instead, you're playing way more of the distribution.
So it sounds like kind of the volatility of the position is like the little versus high Greek footprint.
Yeah,
Also,
it's the volatility of the position, but then also I would summarize it more importantly to like what it has sensitivities to.
mhm. What am I actually like buying or selling at those strikes?
So what you're doing here is you're selling, you're short this 280 call, and then you're buying the 290 call. So when you sell a call, are you familiar with what that means?
You expect the stock to go down then, and you'd get the
Yeah,
premium.
exactly. And then if you're long the call, you think it's going to go up, and you have a different series of obligations or rights. If you buy a call, you have the right to buy something at your strike price before expiration. When you're short the option, you have the obligation to do the opposite. So in this case, you're obligated to sell the 280s before expiration. Now, a small gremlin is, remember, with American style options, these can be exercised whenever, even when it doesn't make sense. Super rare, but it can happen. So you just kind of have to be aware of that. So what you're doing is you're effectively putting on two offsetting positions.
And that's what a vertical spread is. I was going to ask that after that. It's always like a
Exactly.
combination of two.
Yep.
Okay.
So a vertical spread, you can be long or short. You can buy or sell the vertical spread, and you could do it on the call side or the put side, either or.
Okay, so that's interesting. So the higher strike could be either the one you're selling or buying, depending on, and both ways you could like, so there's four combinations basically of vertical
Mm-hmm.
spreads. Okay.
So what I want you to do now is to actually input this trade into your log. And you could pull up your screen, and then I'll walk you through how to do it so that you have a good idea here. So your date time group is 5 August, same thing that you have now. Ticker, you know that. Spot price, you know that, 253.22. Lot size will be a single lot. Expiration is 18 September. This is like your themes or whatever you're basing this on. Good.
Extended.
And now, so where's your long call in the vertical? You have the 280 and the 290.
Yeah, I forget which way it was. Can I see
So
it?
this one's a
Where was it?
short call spread.
So I imagine you'd be. I actually don't know. Are you long the upper end or the lower end? I forget.
You're long the upper end. The way to differentiate between a short or long spread is by whether or not it goes on for a credit or a debit. And the way you know if it goes on for a credit or a debit is whether you're buying or selling the option that's closest to the money, because that's the one that's more expensive. So if you sell the one that's closer to the money, you have a credit spread. If you buy the one that's closest, then you have a debit spread.
Okay, so you could have a vertical spread that's either credit or a debit.
You could buy or sell to open it.
How does that affect, like, if, in this exact situation, if I had it as a credit or a debit?
What you want to happen changes. So let's say that you had a long vertical at these same strikes. Your preference now completely flips. You want it to go above those, and then you would make whatever the difference in the spread less whatever you paid. That's what you would make if it does it.
So, and we're doing a credit spread here.
Because you right now think that it's not likely to go above this level. So we're saying we don't think it's going to go above here.
So credit spread and short vertical spread are like the same exact thing.
Same thing.
Okay. That makes sense now. So the one we're buying is the 290.
The 290.
Is that this? Is that this box?
So K in options language means strike. And that's just derived from like the Black-Scholes-Merton formula and stuff. So then the LCD, that means long call delta. Then you have short call strike, short call delta, long put strike, long put delta, and so on. The reason why those are there is because you see the strategy on the right-hand side. That cell, everything in black there automatically calculates. And that's using a massive series of if-thens based on the various inputs to determine what the strategy is. So you'll see once we finish putting this in, it's going to say SCS, so a short call spread. So your delta on these is 0.15. And then your short call strike is the 280. And your delta is 0.233. Good. Then your premium, and you see how it automatically changed to SCS. So it's just using logic based on the relationships between those. So then the premium, the amount that you're going to sell this for is $1.60. So now what's your value at risk? That's the max you can lose here.
$1.60. I don't know. It can't be
You buy
840,
or
can it?
sell this to
Is it
open.
the same as the other one?
Did you buy or sell this one to open?
Sell.
So is that a credit or a debit?
Credit.
So the most you can make is $1.60. What's the most you can lose?
Oh, is this the one? It's like, is it technically the like entire share price if it just went down and down and down?
Nope,
Or no,
because
up
you
and
have
up and up. Yeah.
you have the long call.
Oh.
So it's the width of your strikes less the credit received.
So it's 840.
So the width of your, go ahead.
So it's 840.
What was it? It's exactly right.
The same as the other one?
In terms of the size? When you say the other one, what other one?
The KTOS one above it.
Yeah, it's the same value at risk. The difference is the trade risk on this one's going to be way bigger because the trade risk on this one is also 840. You don't want to cut your vertical spread early more often than not. Sometimes there's a time where it makes sense. Other times it doesn't. And it doesn't like the DTE. I think that's just because of a formatting thing. Oh, what the fuck? It has it as text. Why? That's bizarre. Anyways, so this is where your portfolio sits right now. You have two different things that are doing different stuff. So then the game plan for you is actually to build more of a portfolio based on the shit that you think is going to happen. And we'll kind of continue to build it together over time. The
And
goal
now,
will be to get you up to like 8 to 10 positions at a time.
so right now I have 1,600 of my portfolio being used, so whatever percentage that is, like 7, 8 or whatever. But
Yep.
that's about what it is.
That's how much is being used. And then you have 1148 at risk.
Mm-hmm. Feels like a lot. I don't know. I guess maybe it's not, but
Yeah, I mean it definitely is a lot. That's the nature of trading a small portfolio. Just about everything you do. And realistically speaking, this trade in Ross is way too big. Like you really shouldn't put this on, but it doesn't matter yet. We're not really worried about like portfolio management and all that kind of shit. It's too early to even care about that. What I'm wanting you to do is just learn how options behave, how positions behave, how things look, and then we'll start working on portfolio management concepts and stuff like that in the future. So you don't even have to worry about it yet.
mm-hmm. All right. Let's go KTOS and Ross can go to where.
Fuck yeah. Let's see you make some money. We will see you all next week. Catch you guys later.